The average executive in the Asia-Pacific region retires with $1.2 million in total assets. That includes their home. According to recent 2026 Mercer research on executive retirement readiness across APJ markets, only 34% of senior leaders age 55 and above have actually modeled their retirement with precision. The other 66% are guessing. And guessing, statistically, leaves you short. Here is what that number really means. 1.2 million sounds substantial until you do the math. If you live to 92, that is roughly $50,000 per year in liquid retirement income. Assuming zero portfolio growth and zero inflation adjustment. In Singapore, where cost of living for affluent retirees averages $80,000 to $120,000 annually, you are already underwater before you pour your first coffee. The pain is not the number itself. It is what the number reveals. Most executives have confused activity with strategy. They have built impressive careers. They have climbed. They have earned well. But somewhere between the promotion and the corner office, the wealth-building machine went on autopilot. Bonuses got spent. Stock options got delayed. Real estate stayed concentrated in one geography. Diversification became a word in a compliance document, not a lived practice. And now, in 2026, with markets resetting, with talent mobility accelerating across Asia-Pacific, with early exit packages becoming weaponized recruitment tools, the illusion is shattering. Executives are realizing they have built a career, not a fortress. What you are about to learn is not theoretical. It is based on patterns from executives who retired with 3 times that average number. Not through luck, through structure. In the next 10 minutes, we are going to dismantle the 3 wealth-building myths that have cost high-earning professionals in Singapore, India, and across Southeast Asia millions in compounded opportunity cost. Then we will show you the framework that shifts you from asset accumulation to wealth architecture. We will walk through real examples from fintech executives in Bangalore, private equity leaders in Singapore, and regional heads who cracked the code on executive compensation. And critically, we will show you the exact application points you can implement this week, not someday. This is not about spending less or working longer. It is about building differently. The first wealth-building myth is that executive salary is your primary wealth lever. Here is the evidence. According to a 2026 Deloitte analysis of senior executive compensation across APJ, base salary represents only 28% of total executive earnings. Yet most senior leaders optimize for base salary negotiation. They negotiate harder for the 28% and largely accept the terms of the 72%. Equity, deferred compensation, performance bonuses, and retirement benefits, without engineering them. Take the example of a chief financial officer at a multinational financial services firm, headquartered in Singapore. Her base salary was $280,000 annually. Over 20 years, that salary, even with annual increases, would generate roughly $7.5 million in gross income. But her equity package, which vested over 5 years and was reinvested through an employee share purchase plan, generated $18 million in accumulated wealth, more than double the salary component. Here is the application. Do not optimize your career around the salary headline. Instead, audit your total compensation statement for the components you do not fully understand. Equity vesting schedules, deferred comp terms, performance multipliers, and retirement benefit formulas are where the real leverage lives. Most executives leave 40 to 60% of their potential total compensation upside on the table, because they did not engineer these terms during negotiation. Specifically, in your next role or compensation review, ask your finance team for a full present value calculation of your total package, not just base plus bonus. Understand the vesting cliff. Understand the performance gates. That clarity alone will show you where your real wealth levers are. The second myth is that diversification happens naturally once you have enough money. The evidence tells a different story. According to 2026 PwC Wealth Management Research, high net worth individuals in Asia Pacific who had a diversified portfolio across equities, real estate, private equity, and alternative assets saw an average 8.7% annual return over 10 years. Those concentrated in a single asset class, typically domestic equities or primary residence real estate, averaged 5.2% annual returns. That is a 3.5 percentage point spread over 20 years. That spread compounds to a difference of nearly $2 million on a starting base of $500,000. The real-world example is instructive. An Indian technology executive in Bangalore built substantial wealth through stock options in her company. By age 50, her portfolio was 87% concentrated in company equity and her primary residence. She had not lived through a meaningful downturn. Then 2025 market volatility struck. Her company stock, heavily exposed to AI sector pullback, fell 34% in 6 months. Her net worth dropped $1.2 million overnight. She had not even retired yet, and her sequence of returns risk had already crystallized. Her course correction involved a deliberate rebalancing. 40% into diversified global equities, 25% into private equity co-investments through platforms like Sanctuary Asia, 20% into commercial real estate trusts across Singapore and India, and 15% into venture debt and structured credit. Within 36 months, her portfolio rebuilt. And critically, it was no longer hostage to a single narrative. The application is this: do not wait for wealth to reach a threshold to diversify. Start now. Segment your portfolio into 4 buckets. 1. Core growth assets, typically global equities, representing 45 to 55% of net worth. 2. Alternative income, meaning private equity, real estate, and structured credit, representing 20 to 30%. 3. Geographic diversification beyond your home market, representing at minimum 15 to 25% outside your primary country. 4. Hedge assets, typically bonds or gold, representing 5 to 10%. This framework is not about being cautious. It is about being strategic. The third myth, and this one costs executives the most, is that your employer retirement vehicle is sufficient. Recent 2026 IDC research on executive retirement preparedness across Southeast Asia found that 71% of respondents relied primarily on their employer-sponsored pension or provident fund as their retirement income foundation. That same research showed that executives who supplemented employer plans with personal wealth-building vehicles retired with on average 4.3 times more wealth than those who did not. Here is the concrete example. A regional operations director at a multinational consumer goods company in Jakarta had an excellent employer pension plan, a fully funded defined benefit arrangement. She believed she was protected. But here is what she missed. The pension, while generous, was designed around a 65-year retirement age and a 25-year life expectancy. She wanted to retire at 58 and potentially live to 95. That 13-year gap, combined with inflation, meant her pension alone would cover only 62% of her aspirational retirement spend. She restructured her approach. While maintaining the employer pension as a foundation, she began investing aggressively in 3 parallel vehicles: a self-directed brokerage account, a private placement cell insurance policy that allowed tax-deferred growth in Singapore, and participation in a regional venture co-investment syndicate. Over the subsequent 12 years, these vehicles accumulated to $2.8 million, more than double her projected employer pension value. At retirement, her total accessible wealth was $4.1 million, not $1.2 million. The application is direct. Your employer retirement plan is a floor, not a ceiling. Calculate your actual retirement need. Most executives underestimate spend during retirement by 30 to 40% because they do not account for healthcare inflation, travel, or support to aging parents, which is particularly significant across Asian cultures. Once you have that number, calculate the gap between what your employer plan will provide and what you actually need. That gap is your wealth building mandate. Specifically, this quarter, meet with a fee-only financial advisor, not a product salesman, and request a full retirement readiness analysis. You need that gap number to make rational investment decisions. This is what the right framework produces. It is not about becoming wealthy. You already are. It is about weaponizing that wealth intentionally. An executive who implements this, who re-engineers their compensation structure, who diversifies deliberately, who builds parallel wealth vehicles alongside their employer plan, does not retire with 1.2 million. They retire with 4 to 6. Thanks for listening. If you found this valuable, please subscribe to Apex Minds D4J for more powerful insights. See you in the next one.